All right, so let's talk about mutual funds first, and a very important concept or a practice that fund managers have is of the cash holding that they have in their particular fund, or they kind of imbibe it in their investment strategy. What does it exactly mean, and what right now is the cash holdings of funds across market caps? That understand all of this, I have with me Gautam Kalia, Senior Vice President, Head Super Investor at Sharekhan by BNP Paribas. Gautam, good evening and welcome to the show. What is the concept of holding cash that fund managers usually hold?
Right. So typically, because most mutual funds allow for redemption at any given point of time, even if there are exit load implications and tax implications, you can get your money and you can place an redemption request anytime and get your money in 2-3 days, depending on the category of fund. So there is a certain amount of liquidity that has to be maintained at the fund house level, at the scheme level, so that they are able to fulfill such requests. It's like your local bank branch having some cash in hand, so that if anyone wants to withdraw some money, they have that cash to give to you. So typically this varies between 0 to 5%, or some situations it may go up to 8-9%. But we've seen that in the last few months, some funds are having a higher holding in cash.
All right, so let's talk about the funds that have a higher cash holdings right now, and also what is the kind of strategy these mutual funds are holding right now?
Right. So, I've provided a list to your team of the funds that are holding higher cash. So, I'll just say a few examples. For example, ICICI Prudential Transportation and Logistics Fund has about 20%. HDFC Focus 30 Fund has 17%. Tata Small Cap Fund has around 14%. So these are some names that are holding higher cash. They are about 15-20 funds, and many of them have cash holdings of greater than 10%. So prior to the show, we had a chat with a few fund managers and fund houses to kind of get a sense of why do they have such high cash holdings, and really it's a function of the rise in the amount of inflows that is coming. So inflows are coming at a faster pace than can be deployed in the market. And second is that gradually, as the market continues to do well, the options to invest in also become less attractive and limited. So obviously, if I'm a fund manager managing a certain corpus, I'm going with my high conviction stocks in the beginning, and then gradually moving into the next level of my conviction stocks as I get more and more money. And then once I reach a stage where I don't want to be put in a position where I have to buy stocks that I'm not entirely comfortable with, I'll hold on to cash and check for valuations, check for other ideas, and then deploy. So that really is what is happening, where we see the market doing well, fund performance, their new entrants to the market coming in, more money coming in from existing entrants, and if a fund starts doing well, then even more money comes in because despite the disclaimers, most investors look at past performance and select the scheme. So success becomes it's like a cycle that propels more funds coming in, and that's when fund houses have to figure out to how to deploy that excess cash. So, for example, the Tata Small Cap has just stopped taking fresh inflows, lump sum, due to such high inflows. And HDFC Focus 30 Fund also, the fund manager doesn't want to put more money in the mid and small cap space. So they are trying to figure out a way to redeploy the excess funds. So this is really what's happening right now.
So Gautam, anything that an investor should be keeping in mind? Obviously, tracking the cash holdings or the cash levels in the fund is going to be a very important thing that an investor should do. But then, if a fund is consistently having higher cash holdings, is it something that investor should be considering about the fund and maybe keeping a track of?
Yes. There's a combination. So when you're investing 100 rupees in a mutual fund, you're expecting at least 1995 of that to be deployed, because you're doing the asset allocation at your level. Now, if the fund manager is opportunistically deploying the cash, that's okay. If the fund manager is keeping 20% because the anticipation is of a market correction and then buying at a more attractive valuation, that makes sense. But if a fund is consistently keeping, let's say, 15-20% in cash, then it's really a cause for concern, because you're not really getting your money's worth as far as fund management fees is concerned. Your money is not being deployed as you expected it to. So those become red flags for us, especially when we look at funds and research them. And that should become a red flag for investors also, especially if the fund house finds it difficult to deploy money, let's say over a 6 month to 12-month period, and stays in cash for about at elevated levels.
Gautam, one last question and then we'll move on to our viewers' queries. Should a decision to exit a fund be based on the cash holding that a fund has? Obviously, I'm sure there are other factors as well, but then this can this be one of the major factors?
So I would say typically no, it's not one of the major factors. But like I said earlier, that if the cash flow, cash allocation is at a consistently elevated level, then you're not really getting your money's worth. You're putting in, let's say, 100 rupees, and if only 80 rupees is being deployed and 20 rupees is sitting in cash or short-term debt instruments for 6 months to 12 months, and in your research you don't see that as being opportunistic, and you don't see that changing, where the fund manager has, let's say, when the market corrects and the fund manager's gone to 95% deployed status. So if it's not opportunistic in nature, then I would say that that's when a consistently large cash holding becomes an issue. But typically what I've seen is that these are imperfections in markets where flows are being managed, and just because a fund has deployed 95% or even higher doesn't mean that that's the best approach also, because you may end up having a very fat tail. You may end up having 70-80 stocks in a portfolio where the fund manager is just buying a lot of stocks to deploy the cash, which may not be in his high conviction basket. So that also is not really suitable for the client.
All right, so I think that's all for this topic of discussion, and we will be soon taking our viewers' queries also. But then before that, in tonight's episode of IDFC's First Bank Presents Leaders of Tomorrow, Season 11, we put the spotlight on India's G20 presidency with an expert panel who discussed the role of technology, women-led development, importance of inclusive growth, and ways to build a sustainable ecosystem. Listen in.
What strategies do you believe should be prioritized to sustain and amplify the growth of women entrepreneurship in India, and how can various stakeholders play a role in achieving this?
Men do 15x less household chores than women do, right? So equity actually starts from home. And that's where we can start with that first step, right? So I think there's one piece of starting from home where male allies can play an extremely critical role. And number two, of course, both in the funding as well as sort of raising capital landscape, how do we make a very effective change?
We will not have equitable workplaces until we have equitable home places. Hardware is all in place. We now need to fix the software, which is social attitudes, stereotypes, so real partnership in the home place, in families, and support and open mindsets.
Yes, of course, the ecosystem has to come together. And once when we marry innovation with, kindling innovation at an early age in schools, getting that support, not just from the family, but from outside, where there's funds coming in because it's a great idea, not because it is being funded or there is a support of a male entrepreneur, but the idea is getting funded.
All right, so for this exclusive conversation, tune in to Leaders of Tomorrow tonight at 10:30 p.m. on ET Now. On that note, let's take a quick break, and then post that, let's take our viewer queries on the show live. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. All right, so that's the place where we keep waiting for your questions. But let's begin. Gautam, I have Mr. Ishwar M's question, and he says that he is 38 years old. And he wants to do an investment of 10 lakhs for next 3 years. And he also wants you to suggest funds where he could double his money. Okay, so that's a very important line in the entire statement, doubling your money. So I really want to understand the concept of this when you talk about investing in a mutual fund. It's not a magic wand, which people really need to understand. So shortcuts in mutual funds, can one really aim for that or strategize for that, Gautam?
Unfortunately, no. You'll have to be very lucky that you end up getting 20-25%, because what Mr. Ishwar is asking is to double his money in 3 years, which is around 26% year return, which is not out of the purview of mutual funds. There are a lot of mutual fund schemes that have given those kind of returns in the past. But that is not the expectation that you should take while going into the stock market and investing in mutual funds. Because I've said earlier also in a previous show that there have been enough times in the past where you've not made even 1% return over a 6-year period, 5-6 year period. So there are many windows like that have happened historically, where even after 5 years you're looking at a flat uh, no performance. So really, the projections that we provide typically are at about 12%, and 12% would mean anywhere between 5 to 6 years, around that period that it takes for someone to 6 to 7 years for them to double their investment. So that's really what the perspective should be. In fact, whatever financial planning you do, it's better that you take a conservative estimate of performance, and whatever plus you get just means that you can probably take you can use more money, you can achieve your goals faster if you end up getting a better performance. But if you get a poorer performance, then obviously that means that you'll take longer, and you probably may have to delay meeting some of the financial objectives or prune down your financial objectives. So we take 12% typically because currently we take a look at the GDP growth rate of the economy, and we keep a track of inflation, and that kind of gives us an estimate of how much corporate earnings will grow, which is a very high important factor in determining share price. And that's really how we arrive at 12% when we make these projections. So for Mr. Ishwar, what I would say is that don't come in with a 3-year view. Please come in with a 5-year minimum view. You're looking to invest 10 lakhs. Please invest in the following funds: ICICI Prudential Future Fund, SBI Magnum Mid Cap Fund, Kotak Small Cap Fund, and HDFC Flexi Cap Fund. So you can split your investment across these 4 funds, uh, but please keep a investment horizon of at least 5 years.
So these funds are recommended based on your time horizon is 5 years. But then what if he really wants to stick to a time frame of 3 years? Would your fund recommendation change, and would you go for a safer or a fixed income?
Fixed income defeats the purpose of his target of doubling the return. So if 3 years is the absolute maximum that he's willing to invest, then definitely my suggestion would be that the most aggressive fund you can take is an aggressive hybrid fund. But otherwise, I would suggest more debt funds in his portfolio, because 3 years is just very low time horizon to invest a majority of the investment in equity.
So all Ishwar needs to do is just increase his time frame, and then maybe the target of doubling his money could become a reality for him. But then we move on, and I have Mr. Rajesh K. Ravindran on phone line with me from Kerala. Hi, good evening, sir. How are you doing?
Hello. Hi.
Hi,
Good. I'm doing
hi,
good.
how are you?
I'm doing
Lovely,
good.
lovely. Is
Thanks.
it raining there? Is it raining that side?
Yeah, it was heavily raining yesterday, last night. Now it's fine.
Now it's fine. Oh, lovely. Kannur is lovely during rains, is it?
Yes, absolutely.
Never been there, but then yeah, it's there on the bucket list for me. All right, sir, we have your question. You want to invest so that you can get 3 crores in 10 years. Any specific goal that's attached to this 3 crores goal?
Basically, currently I'm working. I'm an employee, full-time worker. So, but I have some entrepreneurial aspirations as well. And
Okay, that's lovely.
yeah, and I
Okay.
do a lot of research and network meanwhile, and do small projects and all. So
Lovely. So,
I
what's the
think
area you want to? What's the area wherein you would want to come up with something on your own? So maybe this could be a target for early retirement, or you want to use this money for your entrepreneurial journey.
yeah, both. One is for early
Both.
retirement, meeting
Okay.
my expenses,
Okay.
and
Sure.
also pursuing my entrepreneurial aspirations. So basically, I'm
Okay.
working on healthy snacks, healthy snacking, and healthy food segment.
Oh, that's
So I've
lovely.
done a
Okay.
couple of projects in snack bar, granola bars,
Okay.
and
Okay. Okay.
healthy noodles, such kind of things. So currently it's in a very nascent stage. So, but later on I would need a big fund, and
Definitely. And you
yeah.
think that this is
So
enough for you, 3 crores, keeping your retirement expenses and requirements in mind, and also the money that you need to start your entrepreneurial journey? Is this going to be enough?
uh, I mean, I'm not sure how will be my calculation gonna help
So
me,
we can help you with that
but
calculation, but then you might have to do some homework and maybe get back to us with the amount that you might want to need after doing the calculation and the homework. But then you've got to be very realistic when you're talking about early retirement, and on top of that, also it's
yeah,
not something that your entrepreneurial journey is not going to give you immediate money. Okay, there's not going to
yeah.
be any immediate liquidity that's going to flow in. So you've got to take care of that as well. So let's Gautam, just sort this out for Rajesh, and let's talk about the calculation first, because good that he's aiming for an early retirement, and so far 3 crores is what he thinks would be enough. But then how do you just go back and do this planning, both for your entrepreneurial journey and also to take care of your expenses while there is no incoming income?
Right. So obviously, when you start a business, then there's a certain amount of capital required, and you'll probably need to have a business plan in place, which will give you a sense of how much money are you going to end up investing over a period of, let's say, 3 to 5 years before the business becomes profitable and you start getting cash back, and you can essentially recoup your capital. So that, I think, is the first step. The second is obviously to get a sense of your monthly expenditure and how much is it going to be 10 years from now, depending on inflation and lifestyle changes. So that's the second decision that needs to be done and calculated. And once you have a sense of this, then you can arrive at a corpus amount that will be comfortable to for you to be able to do both, because a lot of small businesses end up dying because of lack of capital, or because the cash flow is not good enough, fast enough uh, for you to redeploy capital, or survive long enough in that business for it to become successful. So that really has to be a combination of both these factors before you arrive at the 3 crore capital. So that 3 crore could be 4 or 2, depending on these circumstances. Uh, if I look at your target, which is 3 crores in 10 years, you'll have to put in a large allocation, which basis your current salary you will not be able to. you'll need to put in about 1.3 lakhs a month for the next 10 years to be able to reach a 3 crore corpus growing at 12%. So my suggestion would be put in about 25,000 if you can to start off with, and then increase it by 10% every year. Do aggressively save. And if you're able to do this at 12% after 10 years, you'll hit 81 lakhs. But if you can extend this 10 years to 15 years, then you'll actually see the power of compounding at play, and that will really bump up the value. What I can tell you is what funds you can invest in to start off with now. You can get into ICICI Prudential Blue Chip Fund with a 35% allocation. Mere Asset Mid Cap Fund and Kotak Small Cap Fund with a 30% allocation, and HDFC Flexi Cap Fund and 361 Focused Equity Fund with a 35% allocation. So these three categories you can put in across 5 funds, and that becomes a decent portfolio for you to start with.
Rajesh, is there anything more that you want to understand from Gautam?
Yeah, thank you for the information. And I think I'll have to do my own research also on this. But he has mentioned only three funds, right? Would that be enough to? I mean, will it limit the diversification because it's only 3 funds he has
I mentioned
mentioned?
5 funds.
5
Maybe
funds he
more.
mentioned, he says.
Yeah. Okay.
Yeah.
Even though
So
it's
maybe you
5,
can just note that down on our YouTube channel, because this show goes on YouTube as well. So maybe you can just note down the names by going there. Thank you so much, Rajesh, for asking us your question today. We move on, and Gautam, I will take Avinash's question, and he says that he's a beginner. And what would you suggest the first fund that he should start his investment journey with?
Right. So Avinash, like you, there are a lot of beginners entering the market now because there is just so much press, there is so much noise, and there is just so much money being made by people around that it's an exciting time, and that excitement is probably what is attracting you here. What I would like to remind you again that this is like an amusement park because of the volatility, and volatility is really the price of admission to create long-term wealth. And you have to view investing in mutual funds as a long-term wealth creation tool. So you need to stay disciplined. And the first sign of weakness in the market, don't take a knee-jerk reaction of selling, exiting, profit booking, things like that. Please continue to invest, because that's how you are able to unleash the power of compounding. So the market really rewards discipline and patience more than intelligence. So, having said that, what I would suggest you do is I'm giving you a mix here. It's not pure equity. So portfolio to begin with is an ICICI Prudential blue chip fund, 40% of your allocation, which is a large cap, which is investing in the largest companies in India. Kotak Equity Opportunities Fund, which is a combination of large and mid with 20% allocation, and the remaining 40% allocation are in a multi-asset setup. So 2 funds there, HDFC Hybrid Equity Fund, which is an aggressive hybrid fund, and ICICI Prudential Balanced Advantage Fund, which is a dynamic asset allocation. So these 2 funds will rebalance between equity and debt asset classes on their own. So that will also provide some level of reduced volatility in the portfolio.
All right, very interesting. And Avinash, maybe if at all you have more queries, what you can do is just WhatsApp us your question or maybe email us your query once again. But then it's a very nice thing that you thought of starting this off, your investment journey specifically via mutual funds. So that is something we really appreciate. Last question, Gautam, of Ananya Chaudhary, and she says that she wants to switch from ICICI Income Fund to any fund that would give her around 10 to 12% in the next 5 years. And in that case, what would be your recommendation and why?
Yeah, so because Ananya is okay investing for 5 years, then I'm also comfortable suggesting an equity fund and especially since she's okay with a 10 to 12% return. So ICICI Income Fund can be switched to the ICICI Prudential Large and Mid Cap Fund if you just want a single fund portfolio, and you can just keep that money there for the next 5 years.
All right. One more thing, a lot of times beginners opt for fixed income funds or the route of fixed income to start their investment journey. In what scenario is this recommendable?
So if your investment horizon is less than 5 years, and your risk appetite is not very high, which means that money, if you invest 100 and it becomes 80, and that's going to be a source of stress for you, and you're going to take a knee-jerk reaction by withdrawing your investment. That is exactly the kind of behavior you don't want to display, and that's something that you need to avoid. And most new investors end up doing that they think of the market as for want of a better word, a casino where people put in money and make money quickly and get out quickly. But really, it's not that. It's about owning businesses in when you invest in equity mutual fund, and then businesses obviously go up and down depending on how successful they are, what strategies do they deploy, and if businesses are successful, then the stock price goes. So if you view investing in equity mutual funds as owning multiple businesses, that's when you will be able to have the right perspective of investing in equity, and that's why you'll understand why it's important to stay invested in the long term. If you're going to view it as a short-term play, then you're better off avoiding equity and staying invested in debt, especially in accrual funds, which are essentially funds which buy some securities, fixed income securities, and hold on to them till maturity. Maybe just keep replenishing the portfolio gradually, and that's something that you can invest in. But then again, the stability becomes much better, but the expected return comes down significantly. Obviously, taxation also is different. So the return then becomes similar to, let's say, a fixed deposit or slightly better.
All right, so I think with that, it's a wrap today. Thank you so much, Gautam, for being on the show and helping our viewers with their financial portfolio queries. And time for a quick break, but then post that, let's get you an exclusive chat with PFRDA Chairman.